Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial markets, and he is there to help answer your questions. Thanks to all of you, whether you're a regular or whether you are here for your first time. We certainly appreciate it. You can follow me. You can follow Cameron on X. I'm at Ben Watson CS. Cameron is at Cameron May CS. Join us over there. That's a great conversation going on there. We post additional information and ongoing discussions and some good stuff. And boy, I'll tell you what, it is an interesting time to be looking at trading index options. And I know I say that every week, but it certainly is, as we see a lot of volatility and a lot of movement in the market. We're going to take a look at that. We're going to take a look at our 14-7 strategy, and we're also going to look at a low probability, but low barrier to entry, low cost to entry, high potential reward, if it's right, type of strategy in a long butterfly spread. So join me as we jump into a couple of quick housekeeping items. And again, thanks to all of you for being here. Remember, everything we talk about simply for illustrative and educational purposes only. It is not a recommendation of any kind of particular security or strategy or account type. When we talk about options today, we're going to be talking about both primarily index options, but this applies to equity and index options. Remember that they are leveraged products that carry a high level of risk. They're not suitable for all investors. Make sure that you're aware of the characteristics and risks of standardized options before considering any option strategy. Now, remember that multiple leg options will involve multiple commissions and transaction costs. Remember that long options, the maximum you can lose in the trade is what you put into the trade theoretically. When you are short an option, there is the potential, if it is American style, for that option to be assigned at any time. Now, we're going to be talking about index options and primarily European style index options, which removes that early assignment risk. But there are other risks involved in trading options, so be aware of those. Now, as we talk about this, we're going to be using the Thinkorswim desktop software platform today. It is a great sandbox to learn how to trade in and to practice and evaluate strategies, especially the paper money side. But there are certain things that the paper money side does not do that a live trading account would do potentially. And one of those is it does not facilitate the early assignment of short options. Now, when we're trading index options that are European style, that doesn't become an issue. When you're trading American style options where there is the potential for early assignment, it is something that you need to pay attention to. So be aware of that. Now, remember that investing involves risk, including the loss of principal. We're going to be talking about technical analysis today, as well as probability analysis. Neither one is a guarantee of future success out there in the real world, and both are theoretical. But Schwab doesn't recommend the use of technical analysis as a sole means of investment research. Now, we're going to talk a little bit potentially about stop orders. Just remember some of the characteristics of stop orders, that they don't guarantee the execution price, just the activation price. And remember, if we talk about hedging strategies, which we have and will in this particular class, remember that hedging strategies generally involve costs. We don't expect theoretically to make a profit on a hedging strategy. It's more of a protective position. Now, we're going to jump into some of these other aspects as we get into this discussion. We're going to talk about index options. We're going to discuss index options strategies. We're going to look at the strategy that we've been evaluating on the Thinkorswim desktop software platform. But I'm going to shift over to that platform right now. We'll take a look at what's going on in the market. And as I do that, this is a good reminder for me to remind you to click on that subscribe button down at the bottom of the page. If you haven't done so already, it's a great way to stay connected to the Trader Talks webcast channel and the community, and it is at no cost to you. So go ahead and click on that if you haven't already. And if you happen to like today's discussion, click on that like button, that thumbs up. That's going to be a little bit like applause on this part. Now, not that I'm seeking applause or we have a big applause sign, but if you like it, let us know. Now, as we talk about this, Bob brings up an interesting question. We'll get into some of the specific characteristics of index options as we work through this. And Bob asks the question, if we're going to close the trade on index options prior to expiration, does it really matter whether we use AM or PM options? And we'll talk about some of those specific characteristics when we start looking at some of the individual expirations. So, Bob, great question, phenomenal question. Hang on to that because we're going to explore a little bit of the short side here today too. Short-dated side, not necessarily the short side of options. But let's take a look at the SPX. Something unique has happened in the last week since we talked last Wednesday. And that unique aspect of the SPX, the broad market, is that we've seen a little bit of a break below the 200 period moving average. Last week when we were talking about this, we were saying, hey, it's holding that 200 period moving average. And it did for another day. And then it broke down through. And now we're seeing a move, still a bit of a gap up sell-off into what we might refer to as a bearish engulfing pattern. A big candlestick that incorporates the range of the previous day. By the way, if you want to learn more about candlesticks, Cameron's got some great webcasts in his Advanced Charting Techniques series, and I'll let him put the link to the playlist out there where he talks about things like bearish engulfing candles. It's also something we talk about in some of our live trading or our live workshops out there on the road, and as well in some of our other live webcasts. So this particular candle today, where we get this gap up, and that was kind of that initial move, maybe that bounce type of move, right? Is now fading, and we're now seeing it moving down. If we zoom in a little bit here, it's still up off of yesterday's lows. So if you're looking for a hold or a close above the high of the low day, we don't yet have a new low day because it hasn't eclipsed yesterday's low, but we don't have a move above the high of that low day yet. The RSI, that relative strength index, the momentum gauge here in this particular case, still moving a little bit lower. It's down in that oversold extreme level. That doesn't mean that it can't stay down in that level. It doesn't mean that it has to turn around here at this particular point. So we're going to take that into account as we apply this to a couple of different strategies. By the way, talking about taking things into account, we've got a survey link out there in the chat. I just happened to notice. Do me a favor, fill out that survey. If you want to wait, you can do that. If not, click on it now. You can set it aside and then come back to it and fill it out at a later date, or you can fill it out right now. Either way, make sure that you fill that out. That helps us to make these sessions better for you. Now, taking a look back again here at the SPX, we're kind of seeing some downward movement. If we were to change this down to a shorter term time frame, I'm going to go to a 5-day, 5-minute time frame, and you can see that gap up this morning and then the push to the downside, not yet eclipsing yesterday's low. And as we start to see this move to the downside, that is, again, starting to see a little bit of momentum gain to the downside here in this particular case. So whatever rally potential was imparted by that gap to the upside seems to be fading a little bit here. Let's take a look at the NASDAQ, the more tech-heavy perspective on the market. Maybe there's a little bit of a lift here. So we saw a gap up and a sell-off, but we're not seeing it pushing down or engulfing yesterday's candle on the NDX. So maybe there's a little bit of rotation if there is some buying into some of the technology indexes like the NASDAQ, maybe some of those technology stocks. We're starting to see RSI ticking up just a little bit here. And the Russell 2000 kind of sitting here and churning. So we kind of have this balanced range. We have a little bit of a green candle yesterday. We have a bit of a bearish engulfing candle, but it is kind of shaded and cheating to the upside just a little bit here. That RSI kind of settling once again into that lower or equal low in this particular case. So that's kind of the broad market perspective. I want to look really quickly here at the VIX, and we'll take a look at what's going on with the VIX. VIX coming off a little bit. So we have kind of a unique situation where the market is moving a little bit lower, and yet the VIX is staying about where it is, or if not, bleeding off just a little bit. And that oftentimes can be an indication that maybe we start to see a bit of a reversal in the VIX. The VIX typically tends not to stay high for a long period of time. Because generally what drives the VIX higher, this volatility index, is from this particular perspective, is the idea that we see a big spike and then it bleeds off very quickly. We've seen, much like we saw in April of last year, kind of a grind higher in implied volatility. We see this grind higher in implied volatility. It wasn't one individual candle or one individual day that spiked volatility. We see this happening over the course of about a week and a half. And so it may be a little bit slower, much like we see back here, April into May. We see July, August, that quick yen carry trade unwind, or this December spike in VIX unwinding a lot faster than maybe we're seeing this one unwind. So we might see volatility unwind. It tends to be mean reverting, but it doesn't look like it's going to unwind very, very quickly. So in this case, as we kind of sit here, that volatility moving a little bit lower, historical volatility, or the relationship here, correlation relationship between the SPX and the VIX. This is the SPX moving a little bit lower. Here's the volatility index kind of climbing. You see that relationship, and then historical volatility versus realized versus implied volatility. The white line is the historical volatility of VIX. The blue line is the implied volatility, the forward volatility. We're starting to see the historical volatility kind of come back in just a little bit here. So that's kind of the overall perspective of volatility. So now let's do this. I want to feed the ducks here a little bit. I want to answer a couple of these questions that are coming out about expirations and about options and theta decay and all of those things. So let's do this. I'm going to change my chart back to my, in this case, my single. Actually, let's do this. Let's change this to my index grid, and we'll take a look at SPX. This is the S&P 500, and this will put us in the right place for what we're going to talk about in the context of our strategies. So on the left-hand side, I have a 1-year daily chart. On the right-hand side, I have a 3-month daily chart, just a zoomed-in view. I have a 50-period simple moving average, which you can see is turned to the downside. We have implied volatility, and I have MACD. So I have momentum, and I have volatility on here as well. One other indicator that I have on this chart is the probability of expiring cone. And I'm going to go ahead and I'm going to share this grid with you. I've done this before. It's in the description for the webcast, but since you all are here, and there might be some of you here who are not here on a normal basis, I'm going to share that with you. Anything that we share, any of the instruments or things that we share, that is simply for illustrative and educational purposes only. It is not guaranteed as to time or accuracy. So I'm sharing that grid with you so that you have something to use or follow along with as well. But the question that Bob asked was, if we're looking at options that are close to expiration, right? Then and we're going to look at closing them down prior to expiration. Now we'll think about this in the context of this scenario, right? So I'm going to go to the trade tab, and we're going to take a look at SPX options. So I'm going to close down my order entry tool here, and we'll just look at these SPX options. And you notice that here on the SPX options, we have some of these expirations. And it's as we start to get into the last week that are AM settled options. Now, they still stop trading. Here's the thing. This particular option, as opposed to this one, the one that's labeled AM settled, that still stops trading the same day and time that this one stops settling. The 21 March settles and stops trading. But this one settles to the print the next morning. So whatever that print is for the index, the next morning at the open, that settlement price, that's where its options are settled to. The risk in that AM settled option series is simply this, that what if there is a gap in the index overnight between the time that the options stop trading and the settlement in the morning? That's the risk in trading an AM settled option. I want to be very specifically clear. There's really no other difference other than to the price at which those options settle. Because remember, index options, especially these ones that we're talking about, these are cash settled indexes. You can't buy and sell the shares of the index because there are no shares of the index. The index is representative of the cash value of the components, right? So what this index option settles to at expiration is either zero or intrinsic value. So we get down to this option at the end of its lifespan, and it's either going to have value or it's not, depending on whether or not the option is in the money or out of the money. If it's out of the money, there's no more extrinsic value. There's no intrinsic value. It settles worthless. If there is intrinsic value, meaning a mathematical difference between the strike price and the stock price, at expiration, it settles to intrinsic value. So the intrinsic value then for this AM settled option, this one, the 21 March, is determined by that settlement price the next morning. So now you say, well, wait a second, can the index gap overnight? And so let's go back over here and let's change our time frame and let's look at this 5-day, 5-minute chart of the SPX, and let's look at this time frame right here. So here was last night's close, and here's this morning's open on the SPX, right? So it's gapped up. So meaning if we had an AM settled option that stopped trading here, it then settles at this price here. Does that make sense? So that's the risk of trading an AM settled option. Now, if you're not going to carry that into expiration, Bob is absolutely right. That risk is minimal because you're closing the trade down positively prior to the expiration, and you're not subject then to this potential for that overnight risk in that AM settled option. By and large, however, just as kind of a matter of course, we've in this particular discussion, in this particular class, we've been staying away from those AM settled options. But if you're going to close the trade down prior to, then don't. That's something that maybe you have to pay less attention to. And so AM options, trade and grow, can benefit from overnight market action. Absolutely correct. Now, the next question that comes up, and I wanted to address this, and I will address this as we get into this next strategy. So I'm going to take these next two questions kind of as and yes, Jerry, you're absolutely right. More activity in non-AM settled options. So I'm going to take this as the next kind of discussion, and that is the 14-7 strategy that we've been talking about. And if you're brand new to our webcast today, what we've been doing over the course of the last little while is we've been looking at this particular strategy right here. And it is a weekly strategy where we sell a vertical spread 14 days to go until expiration. We buy it back at 7 days to go until expiration. And we take it as it comes. At least that is what we've been doing so far. And our kind of rule of thumb, and just kind of our general approach to this strategy, the strategy basis, was when the SPX was above the 200 period moving average. I'll go ahead and add the 200 onto this mix so that we can see it. SIMP, simple, and we'll add a 200 period simple moving average here. Now, you could use any other kind of moving average that you want. Cameron May does a great job in talking about those different moving averages and what makes them work and what makes one moving average maybe preferable to another. But last week, when we put this last 14-day trade on, right, then we moved below the 200 period moving average. So our perspective shifts. So now we have to do something a little bit different. So we go back to our monitor tab. The kind of process for this strategy was sell it at 14 days, buy it back at 7 days, come what may, right? And so here we are. We sold this short put vertical spread, meaning we had a bullish bias still because the index was above the 200 period moving average. We sold it for $1.60. Implied volatility was relatively high. It's higher now. So higher implied volatility has kind of worked against us, number one. And number two, the price of the index falling has kind of worked against us. So look at this. This is still out of the money because our short strike in this particular case is at the 5,500 level. The index still is at 55.66. So it's not down, didn't tag our short strike. But what happened? Implied volatility went up. This is still relatively sensitive to implied volatility, although not hugely so. It inflated the value of this option, plus these options became more expensive as the index went to the downside. So we can close it down right now. We can buy it back for $3.40. And we took a little bit of a loss on this one. We took a little bit of a loss on the last iteration of this trade. So what we're going to do is I'm going to right click and we're going to create a closing order and we're going to buy this back and we're going to see if we can get it for about $3.10. You notice that it's bouncing around a little bit here. I'm going to work this back in a little bit and we're going to go ahead and we're going to click on confirm and send, read through the order, and we're going to go ahead and click on send and we'll fire that order off and see if we can close that trade down. And we did. We got it for $3.30. So we took a little bit, we took about $1.50 loss overall on the trade, which is okay. We were willing to do that. It wasn't at maximum theoretical loss, but let's go back to the chart and let's kind of look at the circumstance now. So now the circumstance is that the price of the index is below the 200 period moving average. So now we flip over. Now we switch to selling call spreads above the market. We were selling put spreads below. Now we're selling call spreads above. So we've got our probability of expiring cone, which is one standard deviation. I'm going to go to my trade tab. I'm going to look out to see where my expiration is. 14 days to go until expiration. That's the 26th March. Okay. And as we do this, right? So MBU says, what happened to our short call vertical? We did that short call vertical on the Russell 2000 and it closed because we put in a trading price, a limit price order to close that trade down. But let's take a look at this here real quick. So we're going to go now and sell this call spread. So I know that I've got about 14 days to go until expiration in this 26 March expiration. So we're going to go back to the chart and I'm going to go to the chart to my probability of expiring cone. And I'm going to put a vertical hash here at 326 at March 26. And so I'm going to go up and I'm going to see where the intersection is of that probability of expiring cone and March 26th. And it's right here at, based on current implied volatility, it's right here at this level at, let's call it, try to make that line even if we can. There we go. We're going to call that right there at 58.40. We'll call it 58.40. Okay. And we're going to look at closing this or selling this spread somewhere at that 58.40. That's going to be our short strike. Now we're going to come back to the trade tab. I'm going to scroll down in my list here in my option chain. And I'm going to look for the 58.40 strike price on the call side to sell. Now I've got 100 strikes. That's 50 up and 50 down. So here's 58.10, 58.15. I've got to go out to more strikes in order to get to that. So I'm going to go out to 150 strikes. And so we're going to go to the 58.40. And here's the 58.40. It happens to be about the 12-cent delta. In this case, implied volatility has come back down. Actually, that increase in implied volatility with a little bit of a little bit of a collapse today has pushed these strikes out and left them with a little bit lower delta. But think about delta as an expression of probability here in this particular case. That means we've got about a 12% probability of this option being in the money at expiration. So that means about an 88% probability of it being out of the money at expiration. Doesn't guarantee that it won't be, but it gives us kind of that perspective. So we're going to look at selling the 58.40, and we're going to look at buying where we're making these 10 points wide. So I'm going to buy the 58.50. And so we're going to bring in $1.75 of credit. This morning when I was looking at this was about $2, maybe $2.30 of credit at the 12 delta, but implied volatility has come back down a little bit here. So we're going to look to see what we can get for this And the expectation is we will take this off at 7 days to go until expiration. Now, here's the thing that I want to look at. If we were to right click and analyze this, and we'll send this to the Analyze tab, here's our vertical spread. All right, this is our call vertical spread, and we can see where our maximum theoretical gain is if the index goes down, and if the index goes up, we know where our maximum theoretical loss is in this trade. It's a defined risk trade, which is to Jerry's question, why I don't put a stop on this trade to manage that loss, because the risk is already managed, right? In this trade, or at least it's defined, and I know what that risk is in the trade, and I'm willing to take that risk, because if I confirm and send, in this particular case, I'm willing to accept up to an $845 maximum theoretical loss for a high probability percentage that I'm going to get a portion at least of this maximum theoretical gain. Now, it hasn't worked the last 2 weeks, but we've been in transition. So now we're flipping over to selling bearish call spreads to take advantage of this move to the downside. So we're going to go ahead and we're going to left click, and I'm going to click on confirm and send, and we're going to try to send this order off. I'm going to put this in our index options weekly strategy, and we're going to click on send, and we'll see what we get. And we got $1.74, which is even better than what we were looking for, which was $1.55. And now we go to the chart and we say, look, now what I'm expecting this to do is have the index stay at or below that spread. This is where I want the index to be, is down here. We've taken a bearish bias now in this particular perspective. Now, one of the other questions that Pablo asked was, we were talking about time decay, and the reason for doing 14 and 7 is that because this is a far out of the money option, that the time decay speeds up initially, and that time decay curve kind of changes a little bit. It inverts from what we're normally used to seeing. So let's do this. Let's go to the trade tab, and let's take a look at that one that we sold. This is the 5840. And I'm just going to left click on this. And instead of firing this order off, I'm going to right click, and I'm going to send this to the Analyze tab. And this is the risk profile of just this single short option, right? This is profit and loss. But now, what if we change in our risk profile graph? By the way, we've got some great webcasts that talk about using this Analyze tab. If we change the risk profile graph to show the theta curve, and we look at this in terms of that price movement, the problem is we can't really get it to look at that kind of time step in this particular case without really kind of skewing these curves around. But what you can see is if we're looking at selling that strike kind of right here, right, at the 5840, that what then tends to happen, let me grab my magic marker here in my annotate tab. There we go. Is that the time decay, if we were to think about this time decay kind of takes that shape there, right? And so that's kind of the expectation. That's how we might look at that time decay projection for this particular option. So I'm going to clear that annotation. I'm going to turn this back into our normal profit and loss perspective, P&L open, and I'm going to turn this back to +1 expiration, so what we're normally used to seeing. So trading graphs this case. In this case, the risk to reward is lower. Why don't we use a 30 delta trade? The 30 delta trade is a lower probability trade, right? It's going to bring in a higher premium, so that's the trade-off. We've been looking at trying to take this capture of that initial time decay and that initial move far out from being hit. So that's the reason why. Now, you can certainly do it the way that you want to. But now let's look at something else. So I want to come back over here to this chart, and I want to go to the Russell 2000, RUT, right? And this is the Russell 2000, and you notice that the Russell kind of in the last little bit has been finding perhaps this bit of a support level, kind of right here around this 2020 mark, right? And it's been settling back on a level where it settled in support once, twice, three times. Once is resistance, now four times testing this support level, right? So my idea might be that as this volatility has been increasing, we're starting to see maybe a little bit of a momentum reduction. It's not pushing to the downside quite as much, that this might sit here for a little bit, right? And as we sit here at this point, maybe we can take advantage of, again, a low probability trade, but also a trade that returns to kind of shift this perspective. If the short call vertical in this particular case gives us a low potential return on a high potential risk, now we're going to shift things a little bit. We're going to take this from a different perspective and say, let's take a low probability of gain, but a high return if it does work in our favor in this particular case. So shifting probability for potential profitability in the trade. The one that we just did, high probability, low potential return. This one is low probability, high potential return, and I'll show you what we're going to do. So we're going to create a long call butterfly in this particular case, and we're going to do it right here at this area where the Russell 2000 has kind of found a bit of a support level. So we're going to stay, the expectation is that at least for the next little while, the Russell is going to stay kind of within this range that it's been within, and we can see where that range is simply from a volatility standpoint. If we kind of look at where that probability of expiring curve is, and I'm going to go to the trade tab now, and in the trade tab, I'm going to look at creating a butterfly spread, right? I'm going to create a butterfly spread here, and we're going to go down. And we're going to take a look at where we can maybe take advantage of some additional implied volatility, because this is a strategy where high implied volatility and falling definitely benefits us as a trader. So I'm going to look at this one, the 21 March, 9 days to go until expiration. I'm not going to, I'll feed the ducks here again, Bob. I'm not going to use the AM settled. I'm going to use the PM settled expiration index option here in this particular case. And I'm going to go 9 days because, again, I don't have early assignment risk. We're going to be selling an at the money, actually two at the money call options. But if we were doing this with an American style option, 9 days to go until expiration, we're running a potential risk of being assigned early. But because this is European style, we don't run that risk. So it allows some flexibility for selling a little bit closer to expiration. So I'm going to go to the 21 March expiration. I don't need 150 strikes, but I'll leave them there. I'm going to scroll down to my at the money strike, which happens to be that 2020 strike. Index is trading right at 2020. So here's how we're going to construct this strategy. I'm going to sell two of the 2020 strike on the call side, one, and I'm going to sell two of them. So if I were to just leave it right here, just selling those two calls, bringing in a pretty good credit, but if I click on confirm and send, I've got infinite maximum risk in this trade. The potential is, if this index goes up, wow, I'm left with theoretically undefined risk in the trade. The realistic scenario is the Russell 2000 going to go to infinity in 9 days? Probably not. But that's what it's listed as. So now what we're going to do is we're going to define this risk somewhat. So that's a big credit that we would be bringing in. But here's what we're going to do. If that's the 2020 strike that I sold that at the money strike, I'm going to go to the 2010 strike. So 10 wide on the in the money side, and I'm going to buy the 2010 call option on the in the money side. That defines the risk for at least one of those short calls. And then I'm going to go to the other side and I'm going to buy the 2030 out of the money call, which defines the risk on the other side of the trade. Now, here's the thing. Implied volatility has been bouncing around. I can buy this spread for probably somewhere around 35 to 40 cents. Buy the spread, okay? Now, look, if I do this, if I hit confirm and send here at this particular point, look at what my cost of the trade is, 35 cents, or times 100 shares, 35 bucks. Look at what my maximum potential profit is in the trade, $965, and I don't have early assignment risk. So this is a low probability of success, but high potential gain if we were to try to take it to that maximum theoretical gain. So $9.65, $10 wide spread minus the 35 cents, that's our maximum theoretical gain in the trade. But let's look at what that really means. Let's right click and analyze this trade. So I'm going to send this to the Analyze tab. Here's my risk profile. So some of you are familiar with this, some of you, this is brand new stuff, but think about what this means. This means that if this is our zero line, right, our maximum theoretical gain is $35 on either side. So if the index goes way up or the index goes way down, that's our maximum theoretical loss. So at this particular point, my maximum theoretical gain comes right up here at the top if at expiration, 9 days from now, this option expires and the index is right at 2020. That would get me my maximum theoretical gain, right? But that's a low probability scenario. So look, what if we were to say, hey, I want to widen my probability area at a low cost entry? Now we could do that because look, if we were to make a trade that looks like this, what does that risk profile look like for those of you who are familiar with risk profiles? What would that risk profile look like? An iron condor, you're right. That would be roughly the risk profile for an iron condor. But an iron condor is going to represent short, we're going to bring in a credit, and it's also a low probability trade, and it requires time decay to move. And so it also involves 4 legs. Well, so does this, but this is a lower cost, I think, to enter in terms of this trade. So let's do this. Let's kind of think about this from this perspective and say, all right, well, what if we were to look at getting out of the trade if we could gain about half of that theoretical maximum gain? So if we were at right click, we said, all right, what's our theoretical maximum gain? $960. What's half of 960? Let me just kill that. We'll come back over here. We'll say $9.60 divided by 2 is $4.80. So we got to overcome our 40 cents. So $4.80 plus 40 cents. We're going to get out of this trade if it trades for $5.20 or more. So that's how we're going to create this trade in exiting the position. So we're going to use that as kind of our target and gain half of our theoretical maximum gain, right? And you could, Alan, you could do this on a shorter term time frame. You could even do this on a 0 DTE or 1 DTE perspective as well. Give it a try. Let's practice it and see. Let's take a look at that maybe next week when we come together and talk about this. So I'm going to create this trade, and I've already got it queued up in the order. What I'm going to do is I'm going to change this to a first triggers sequential, and I'm going to right click and I'm going to create an opposite order. So I'm going to say, look, buy this back, or actually sell this back if I can sell it back for $5.20 or more, right? And I'm going to make that one good till canceled. So I'm either going to hold this through till expiration, get what I can get for it, or I'm going to get tagged on this limit order and it's going to sell this spread back for about half of my maximum theoretical gain. If I take maximum loss on this trade, which is 45 cents, that's not a huge deal. Now, if you scale up in terms of number of contracts, that can add up. But we take away assignment risk, we put this into that perspective. Low probability of entering the trade, low probability of maximum gain, but we've increased our potential probability here by putting on this order to close the trade down at 520. All right. This is not an AM settlement. This is the PM settlement option. So we don't have to worry about that overnight risk. And why did I choose Russell instead of the SPX for this trade? I'll show you why. We went back to the chart and I said, look, Russell 2000 kind of sitting right down here on this support that it's tested once, twice, 3 times, 4 times. So I have from a technical analysis perspective, kind of a support probability that exists here at this 2020 level. That's the reason, Jerry. But you can do it either way. You can do it on SPX as well. There's nothing that says that you can't. That was the reason why I chose this one. In this particular perspective was the fact that it is giving me some likelihood, no guarantees by any means, but some likelihood that it may coalesce or settle right around that 2020 mark. And it's a short-term trade. Now, it might not. It might go outside that range. But we know what our theoretical maximum loss is on the trade. Now, the other difference in terms of putting this trade on versus, say, for instance, an iron condor would be that iron condor, if it does go up or down, could give me a maximum theoretical loss that could be pretty significant, right? In this particular case, my maximum theoretical loss is what I'm paying for the trade. So I'm going to look at locking that in to answer DP's question. I'm going to lock in that debit. We'll see what we get here. But you're right, it is bouncing up and down here a little bit. So we're going to go ahead and we're going to click on confirm and send. We're going to read through this order, make sure that we're aware of any risks here or alerts that pop up. And we're going to put this in our index options. And we're going to click on send. And we're going to fire that order off. And we bought it for 30 cents. Now we've got that working order there, and we know what our expectation is. We want this price to settle right around that 2020. What would be the optimal price to sell this butterfly? If we could optimally sell it for about $9, that maximum theoretical gain, $9.70 would be max theoretical gain, right? Or it settles exactly at that expiration, then we would potentially get maximum theoretical gain. But we've increased the probability of success in this trade by being willing to take this trade off at less than maximum theoretical gain, right? So, but still a substantial potential gain. Max loss on this trade, 35 or $30 in this trade. Max gain was theoretical max gain $9.70. Max loss on the trade is $30 from that perspective. And so that's kind of what we're looking at here in creating this trade. So low cost to enter, low probability of success, but also we've kind of shifted that a little bit by putting that order on to take it off if it does something a little bit different. So you notice our 14.7 trade here is just kind of sitting right about where it was, not really moving on us yet. And then here's this trade, our Russell 2000 butterfly spread. Now, butterflies work well in high and falling implied volatility environments because we're trying to erase as much of that extrinsic out of those short strikes, which are at the money strike. But the nice thing about a short strike being at the money is that that has the greatest sensitivity to two things: time decay and Vega volatility. Volatility sensitivity is highest at the money. Data sensitivity is at the money. Both of those circumstances are what we want happening here to eat away at the premium on those short legs. So that is the perspective. Now, probabilities are these. Alan, how does changing the trade base from a call to a put change the probabilities? Puts tend to be more volatility sensitive to the upside. So if we get a move to the upside or a move to the downside and volatility increases, that could work against us harder. So a lot of times you'll see traders, many times you'll see traders creating butterflies with calls as opposed to puts because they benefit from a fall in implied volatility. Calls typically tend, kind of like puts, rise more when implied volatility goes up. Puts typically tend to fall a little bit faster when implied volatility collapses, and that's the expectation there. So some of the thought process around that. Hey, if you want to learn more about these strategies or anything other strategies that we talk about, here's a great place to go to youtube.com/@TraderTalks webcasts, and you can type in butterfly. Fly away, butterfly, and you've got a bunch of discussions, basics of butterflies, all about butterflies, butterfly spreads with flag patterns, managing butterflies. There's a good one that Cameron talked about, why pursuing maximum theoretical gain on long butterfly spreads can sting. So some great webcasts here to help continue your education. And again, my thanks to Cameron May for helping out. Remember, we had that survey there out in the chat. Fill out that survey. Help us out. Make this session better. My thanks to Cameron May for helping out. Follow us on X @BenWatsonCS, @Cameron May CS. And I will see you guys again later this afternoon for market and sector analysis. And then we'll be back next Wednesday with another Index Options webcast. Take care, everybody. Have a great day. Bye-bye.